Hello and welcome to the Global View on this Wednesday. Let's take a look at what's going on at a macro level. US consumer prices unchanged in October, while underlying inflation, which excludes food and energy, recorded the smallest rise in 2 years, up 0.2%. In the 12 months through to October, the consumer price index in the States climbed 3.2% after rising 3.7% in September as Americans paid less for fuel. Gasoline prices dropped 5%, offsetting the continued increase in the cost of rental accommodation, although the pace of the increase slowed considerably from September. And the data shows that the Fed's rapid tightening of monetary policy is working, and has bolstered the view that its rate hiking cycle is at an end. Financial markets now pricing in a more than 50% chance of a rate cut by next May. And in line with expectations that US interest rates may have peaked, Treasury yields fell, the US 2-year yield sliding to a 2-week low of 4.84% and the 10-year down to 4.43%. That's its lowest in 2 months. And those lower yields dragged the US dollar index down around 1.3%, which boosted the euro and the Aussie also benefiting, surging more than 2%, taking it above 65 US cents. And in further data, the Eurozone economy contracted marginally in the third quarter, underlying expectations of a technical recession there if the fourth quarter turns out equally weak. However, the jobs market has strengthened. And wages in the UK grew at a slower pace in the September quarter, adding to expectations that the Bank of England will maintain rates at current levels. All right, well, let's get stock specific now. And my next guest saying he's identified one of the best large cap stocks to invest in for the next decade. To take us through it, Rob Shears joining us from Valor Private Wealth. Rob, very good morning to you. Great to catch up with you again. So look, I've teased everyone with that stock, but before I'll leave them hanging just for the moment because I do want to get first your perspective on what you've seen over the course of US earnings season. What's your take out at the moment?
I think it's showed some resilience in the US markets. I suspect that whilst inflation figures were quite attractive last night compared to what they have been over the last year or so, the job may not still be done. There's still some optimism. First and second order thinking is that a lot of money from the share market then flows through to consumer spending as well. So as much as we think that inflation may have eased, higher stocks might lead to further spending. So there's a bit of chicken and the egg happening there. But the news was good last night. It does suggest that cooling is happening at a reasonable pace, and sort of that Goldilocks economy soft landing scenario potentially playing out. As you said from your previous guest, you've got some of the retailers reporting in the next couple of days, which will be quite interesting.
Yeah, Rob, do you believe in Santa Claus? Do you think that rally's coming into the end of the year?
Looks like it's happening. So, statistically speaking, it's more likely than it's not. So, there could be a couple of percent rally between now and Christmas. I do not think the stock market is obviously cheap. So any rally from here is on top of already full valuations for a lot of stocks. Having said that, I do think that outside the mega cap companies, which are where a lot of the rally has been in the last year, there's some fantastic value, but it's just not in the big ones.
All right, well, talking about the big ones, and I did tease this, of course, when you're calling this one of the best large cap stocks to invest in the next decade. Rob, you're talking about Constellation Software. First, talk us where it's been this year, because it's some impressive gains already.
Yes, the Constellation Software has risen by 54% in the last 12 months, which is pretty impressive. But that's on the back of they call it free cash flow available to shareholders. That's their own metric. But the sort of, if you look at their metric, it's a fairly honest way of reporting. And that's up 60% in the last year. So the share price growth is sort of along with their free cash flow growth, which suggests that it's not obscenely overpriced and it's sort of growing along with its fundamentals. So 54% in the last year is a very attractive place to be. Our biggest mistake is we didn't invest enough. So we've only got 5.7% of the stock, and our biggest mistake is we just didn't buy enough.
Yeah, well, you can always have that regret, can't you, Rob? All right, okay. So tell us then, what does Constellation Software do?
So yeah, a lot of Aussies don't know Constellation Software, but it's a $65 billion company. So it is an enormous company. Just because it's diversified over around 850 subsidiary businesses, there's not really household brands. It's not, so the enterprise software is, everyone knows about Microsoft and everyone knows about the Google suite of software, etc. Because that's enterprise and it's across lots and lots of different companies. What vertical market software is, which is what Constellation Software focuses on, is just tiny little pieces of software for individual companies or individual industries. And a lot of this is business to business software. So it's not something that you'll see in everyday life, because it's very bespoke. But it's because of that nature that's actually so sticky, and that's why. And a lot of these pieces of software are less than 1% of the revenues of the companies using them. But the switching costs are enormous. So it's actually a really wide moat around this business, diversified across 850 companies, 850, more than 850 pieces of software, and diversified very nicely. But it's what John Hampton likes to call small things which make big things better, which make it very, very difficult to displace these pieces of software.
Yeah, so you're pointing out here that they say that there are some 40,000 targets in their domain, so underlies the growth story for the company.
Yeah, correct. And the US term is it's in the first or second innings of their round, but in Aussie terms, it's the second day of a test match. So they've still got a fair way to go. With 850 businesses with a target of over 40,000, this growth story is still in its middle stage, early to middle stages. It is not yet done. And if you look at the results which came out in the last couple of days, late last week, it's 23% revenue growth for a $65 billion company, which is still very attractive. But they're getting margin expansion because their costs only went up at 18%. So that's where you get that 60% free cash flow available to shareholder growth, because their costs are going up less than their revenues. And a lot of that's to do with the organic growth. The organic growth is the highest it's been in the last couple of years at 8%. They have built into a lot of their contracts inflation-linked contracts. So if there's higher inflation, they get more organic growth just naturally. So this is a beautiful company with, and it truly is anti-fragile. If you look at 2022, a pretty bad year for particularly their biggest competitor, private equity. Private equity was getting hit on two fronts. First of all, their debt was getting hit by higher interest rates, but also they couldn't relist a lot of their businesses back into markets. And so their biggest competitor was struggling. Constellation Software accelerated because of the downturn. So Constellation Software will do better if there's worse times.
Yeah, that's interesting then. Certainly showing that resilience. We did point out those results that just came to us were not quite as impressive as the previous year. But Rob, if you're saying it does well when perhaps the economy is not, expectations then beyond this year into next, perhaps when we do start to see rate cuts, how's that likely to affect the outcome then for the company?
That'll actually probably slow growth. It's 23% growth. I would suggest that might be lower if we see a soft landing and potentially lower rates next year. So their biggest competitors, and what happened last year was the price of their targets, their 40,000 targets, went down, and so they bought more. So if we see moderating borrowing costs and private equity able to potentially maybe relist some of their, the way private equity works is they buy a company, rip the guts out of it, and sell it to an unsuspecting buyer. That works in good times. It doesn't work very well in bad times. So their biggest competitor will do well if we go back into better times in terms of lower rates. So it could actually slow down Constellation Software in the next year. But the beautiful thing is that no one knows whether inflation is truly tampered or whether it's, and you look at the 1970s, the number of times they paused rate rises and it was actually the wrong thing to do. So if we do see inflation kick off again and if we do see higher rates again, then Constellation Software is a perfect hedge for your portfolio. Having said that, if it grows at high teens instead of low 20s for the next 5 years, it's still more than acceptable because it's not extremely expensive. It's trading at sort of not dissimilar rates to Apple. Apple trading at high 20s times next year's earnings. I think that's roughly the same valuation of Constellation Software. The difference is that Apple just won't grow at 20% a year.
Yep.
So it's much more attractively priced than something like an Apple.
And just drilling a little further into the company and its structure, Rob, so it's got a number of different verticals just as far as its subsidiaries are concerned.
Yeah, correct. So they've been spinning off some of their smaller businesses, or the large, some Topicus and Lumine and Signity, which is the one in Warsaw or in Poland, very few people know about. So they have a lot of these subsidiaries, and they're spun off for a reason, often to raise some capital for an acquisition to keep their debt very low or actually positive net cash. And I think that something like a Topicus, which also reported last week, that's an attractive place to be. They're I think about a $7 billion market cap, so a lot longer platform for growth, but it's focused on Europe. So Topicus focused on Europe and really focused on European vertical market software businesses. Has a very, very long platform for growth, and so that's an attractive place to be. Is it as attractive as the mothership as Constellation Software? I'm not sure it is, because obviously still Constellation owns a very large chunk of they own 50% of the shares in Lumine. So I think that it's probably better to buy the mothership. At certain prices, it's better to buy the subsidiaries, Topicus, Lumine, and Signity. And it's just that I think that the reason they spun them off is they may not be as good at businesses as the mothership.
All right. So just to round it up then, Rob, you've said perhaps your biggest mistake is not owning enough, so you feel as though perhaps you're going to load up a little more then at this point.
On weakness, we'll continue buying it. Not at these prices. We'll wait until there's a pullback. There's always a pullback in markets at some point in time.
Absolutely. Rob, thanks for joining us from Valor Private Wealth.
Thanks, Andrew.
All right, just before we go, a check of the markets. SPI futures, they're up a healthy 1.3%. That's after a really strong rally we saw on global markets, particularly stateside, overnight in response to that cool and expected inflation read. Stay with us, the open just around the corner.